Okay. Ooh. Put that on silent. There we go. Good morning, everyone. Right, let's get underway. Welcome to the Best of Wyckoff. Wyckoff Rediscovered 2010. This is a dream come true to have all such great speakers around me, and I'm going to introduce you to them shortly. Suffice to say, we've got a lot to cover in 2 days, and it's going to be a little bit like drinking out of a fire hydrant for some of you. There'll be a lot of information that's coming at you, and we do know, having done these seminars now for many years, that people forget the information. That's the last thing we want you to do. So you can see we are recording it. You will get an archive. We do encourage you to go back through the archive more than once. How many of you here, can I just ask if I may, have read the book Master the Markets by Tom Williams? Just want to see the majority have read. Okay. And how many of you have read any works by Richard D. Wyckoff? Okay. And I know on the internet a lot of you are going to be completely new to what we're talking about. So we're going to, for the first 30, 40 minutes here, I'm going to set the scene for who our speakers are, what we're trying to achieve from the 2 days, what we're trying to help you with. And then we're going to start to get into, with Paul and I, and with Andy, for the first 2 keynote sessions, some actual specifics. Now, if you've got a question, just raise your hand up, and obviously we don't want to break the flow, but if you don't, if you've got the question and it's niggling, write it down if you don't want to put your hand up, and come and see us during the break. One thing about these events, the reason we put them on, most educators currently are cancelling live events because nobody turns up anymore, sign of the times. We're very fortunate that unfortunately, few people couldn't make the event the live event due to plane cancellations. But we've got a great group of people here in West Palm Beach, Florida, and I know we've got a full audience out there. So today, I want to just quickly take you through who's in the room here and also who's coming in from the United Kingdom. Now, I'm really very, very pleased to announce that we have actually secured a conversation with Andrew Maguire. Now, Andrew Maguire is a specialist metals trader with over 40 years' experience in trading, so a lot of experience. 17 of those were trading specialist precious metals. He's currently in the news as a central player in an ongoing effort by the CFTC to prevent manipulation in the silver and gold markets. Andy has a unique insight into the footprints being laid down by certain large players, and Andy works alongside his business partner, Paul Coughlin, who's from Coughlin Management based in the US, like me, a fellow Brit who ended up coming here, meeting a woman and getting married. And he's here with us. Yeah, that's the story. He's like, that's it. That's what happens. And he's going to be here today with Andy, talking a little bit about not a conspiracy. Let me be very clear here. If you went to Google right now and you typed in Andrew Maguire, as you can see, I've already been... This is how I found and connected with these guys, by the way. You're going to see all sorts of reports, some correct, some complete nonsense about this gentleman. But let me tell you why I'm honoured to have Andy in the UK presenting here, because a lot of newspapers that have been contacting him for interviews, he's refused. A brief background, and I'm not going to say it's very brief because Paul will tell you a lot more, but Andy worked once with a large institutional bank, and he could clearly see over the last few months, that the markets were moving in very unusual ways, especially on the gold and silver. And he decided to write to the CFTC and say, hey, guys, the market's been manipulated here. This can't be real here. I'd like you to take notice. And in fact, I'm so confident that the market's going to be rigged here that I'm going to give you days in advance exactly where the price is going to go to before it's even there. Of course, everyone said, OK, we'll see what happens. Suffice to say, Andy nailed it because he knew what was going on. And he chose to do what I have chosen to do, which is to try to keep all of you listening out there and here out of trouble. And that's exactly what these gentlemen around us are doing. So you can see there's lots of stories on the internet. I mean, thousands of YouTube videos and hundreds of YouTube videos. But the mainstream media have avoided this like the plague. You won't be seeing this on Anderson Cooper CNN, despite the fact that I've written to Anderson and I've also written to several other publications with evidence, saying, hey, we have a website, which how I got this website was strange in its own right, but marketmanipulation.com, which we own, has now been swamped with hits. It's been taken down several times. I'm not sure why, but it's up and people are listening. And the people in this room who've signed in from the internet are listening too. So going back to our speakers, we've got several speakers that are eminent at the moment in the world of Wyckoff. I'm not going to talk, because of time, too much about all of those speakers, but suffice to say, I want to thank them for being here. We have David Weiss, who's recognised as one of the world's, if not the world's, leading expert in Wyckoff. David has taught and mentored many people, and I connected with David through our second speaker, who's going to be Dr. Gary Dayton, who isn't here at the moment live. Unfortunately, he's got stuck in a plane as well, but he's got a lunchtime presentation after lunch, and I'm told, touch wood, that he'll be with us, which is great. We've then got Gary Fuller, who runs a chat room. I subscribe to his newsletter. Totally impressed with the quality of the work. Again, it's all based on the principles of Richard D. Wyckoff. Some of you don't know who he is. You will do shortly. Wyckoff is very much part of what I teach. I was taught to trade by Tom Williams. I'll tell you more about that shortly. Of course, we've then got Paul here from Coglan Capital, we just talked about. And Paul and I are going to be, in session 2, covering some actual chart patterns that you can follow through. Then to my right, I've got Robert Hoffman. Okay, Robert is a full-time professional trader that runs powercharting.com, which uses TradeGuider VSA methodology. Rob's results speak for themselves. Several, I know, of you here follow Rob's work. He trades like me. We trade real money. We trade it live. We trade it at the right edge. And we show you that we are real because we're trading not on a simulator, but with a real account, with real setups. And we do that. I do it 3 times a week. Rob does it every day. Due to regulations, I can't tell you how many wins or losing trades that Rob has made, but you can go and find out for yourself because he's videoed them all. And suffice to say, he's very, very successful. And we've also got Tom Williams, the man that taught me to trade. He's coming in tomorrow morning over the breakfast to talk to you about his newsletter, which is fascinating, which he's produced for you. I've also want to introduce you to Sheenan Showers, who's our COO at TradeGuider, and Richard Bednall, who's going to be filming and is the co-owner of TradeGuider, marketmanipulation.com. And as I say, we've got Gary Dayton joining us shortly. Now, a little bit about who I am, because a lot of you out there don't even know who I am. So I'm going to tell you just very briefly, and we're going to get through to the meat on the bones. But I'm formerly a police officer like Rob. The main difference between Rob and I when it comes to policing is Rob, if you've got sort of a picture of him with his police uniform, he'd have a big M16 rifle and a big stick and spray. British police officers don't carry guns, and our little batons are about that big, which is very tiring, and we have no protection when we went into the fights and stuff like that. You were trained, weren't you, as a self-defence teacher, I believe, or
I was a police defence tactics.
A police defence tactics, yeah. Well, a lot. You needed to teach me because I got beaten up several times when I was doing the job. But anyway, suffice to say that I had a meeting that was very fortuitous. It's a meeting that changed my life with a trader called Tom Williams, who was a former professional syndicate trader. He traded in a syndicate in Beverly Hills. Syndicates, by the way, don't put signs on their door and say, we're a syndicate and we make speculative attacks on stocks. No, they don't do that. They just, trust me on this one, Tom was looking after, and his syndicate, a serious amount of money 25 years ago, and he learned how the markets worked. But what happened with Tom, what was fascinating, is they brought him in as a registered nurse to look after one of the traders who had a drug problem. And then he began to get fascinated by what was going on, so he began to draw charts from them. And as he'd do the charts, he got fascinated that the markets moved at certain points and there was large or heavy orders going in. And he wanted to know what the hell was going on here. How was it? So they sent him on the Wyckoff course. And the Wyckoff course is still taught today, in fact, by Professor Hank Pruden at the Golden Gate University in San Francisco. But what Tom did is he developed a computer software program which we own called TradeGuider. Okay? And TradeGuider is a program that doesn't just, it's not a black box, it doesn't give buy-sell signals and tell you trading is easy, but what it does do is it tells you how the market operates based on supply and demand. Now, before I go further, there's two things I would just like to add as well. This event today is being sponsored by PFG Best, and at the back there is Mike Panici. Mike, if you want to stand up, and thank you for sponsoring. Mike's looking after us here. And then Craig Russell is from eSignal, who are also our key sponsors. And I want to thank both those guys as well for supporting what is a very good cause.
What is PFG Best?
PFG Best is a brokerage firm based out of Chicago, and I'm sure at break Mike will tell you all about PFG and what they actually do. Okay, so I was taught to trade by Tom. I now travel the world teaching people how to read a chart using price, volume, and what we call the range and the spread of the bar. And in summary, Richard and I own a number of websites that are there to guide traders how to operate more efficiently in the markets. Marketmanipulation.com at the moment is our busiest, VSA Club and Trade Guider. That's me for you online, for those of you who can't see me and my family. And I'm delighted to also announce that we've got a new CEO, Richard, starting with the company on Monday, because obviously I think I'm having to resign. So I've got a picture of him for everybody. That's the new CEO. That's Ryan. He's 5 weeks old, and he's my son who was recently born to my wife Laura and I. Okay, let's now bring this together. Richard DeMille Wyckoff, November the 2nd, 1873 to March the 19th, 1934. He was a stock market authority and a founder and one-time editor of the Magazine of Wall Street, which was founded in 1907. So some of you are thinking, why on earth are we talking about somebody in 1907 today? What's the relevance? Well, the relevance is very clear, that what was happening in 1907 hasn't changed, because the markets are driven by human nature, and that's what causes the markets to move. There are a number of factors. But this is what Wyckoff said all those years ago. Thousands of those who operate in the markets now recognise the fact that the market momentarily indicates its own immediate future, and that these indications are accurately recorded in the market transactions second by second. And therefore, those who can interpret what transactions take place second by second, or indeed moment by moment, have a distinct advantage over the general trading public. Tom George Williams, hopefully he's watching. Tom, if you are, I hope you're here. Born February the 4th, 1929. Very distinguished gentleman, as you can see. And he says, if you can read a chart correctly, understand the markets do not move randomly, but are moved by the smart money, and you can see their intention at support and resistance levels, which is actually why Paul's here, because I sat in his seminar for the first time last week, and this is exactly what happened. When we talk about support and resistance, Tom Williams taught me just how important that is. I call them trigger numbers, and as I was trading the British pound live, Paul was identifying on his charts exactly where I took a trade. And we hadn't met, had we, before Tuesday, and it was fascinating to see somebody that I hadn't connected with aligning almost bar by bar with what we teach. And I think you'll find today, you'll find what we're going to show you pretty fascinating. Volume, it says, is vital in your analysis, which is why the self-regulated exchanges around the world will not release true volume figures until the day after trading takes place. Richard Ney. How many of you have heard Richard Ney? Just raise your hands. Okay, I've got one of his signed books, by the way. It's worth a bit of money, I think. But he wrote a number of books, and the two most famous are The Wall Street Gang and The Wall Street Jungle. He was an actor, an investor, but most of all, Richard Ney wanted to warn the public how the markets were operated. He said, in which it is shown that if you scrap traditional approaches to the market and attack the financial conspiracy with its own weapons, you can beat the stock exchange insiders at their own game. Hold on now, what's this guy got to do with anything? Charles Lucky Luciano, was he a trader? No, he was actually a gangster. He was born in November the 24th, 1897, and he passed away in 1962. This is a true story from Richard Ney's book. It says the story is told that after he'd been deported to Italy, Infamous New York City gangster Lucky Luciano granted an interview in which he described a visit to the floor of the New York Stock Exchange. When the operations of the floor specialists had been explained to him, he said, "A terrible thing has happened. I realised I joined the wrong mob." Now, that, in its own right, is a true story. What does that mean to us? What is, why is these people all connected to everyone in this room? And there is a connection. Who's heard of Jim Cramer here? Everybody? Anyone doesn't know Jim Cramer? Okay. And James Cramer was born February the 10th, 1955. He's an American television personality, a former fund manager, and a best-selling author. Cramer is the host of CNBC's Mad Money and co-founder and chairman of TheStreet.com. There's many videos that Jim Cramer has made, and I want to honour Mr. Cramer. And the reason why I do is I feel that he's trying through the mainstream media, and I don't know what your thoughts are on this, Paul, but I think you know Jim Cramer, obviously, you've seen him. My feeling is he's trying to, in some ways, warn people. He used the word on the Jon Stewart show, the TV show, when he was trying to explain how the market operates. He used the word shenanigans. I thought that was quite amusing. He didn't say manipulation, but I'm pretty sure he meant the same thing. And he said, in the interview in 2006, which caused a storm, he said, a lot of times when I was short at my hedge fund, and I was position short, meaning I needed it down, I'd create a level of activity beforehand that could drive the futures. It doesn't take much money. He goes on to talk about 20 million here, 50 million here, figures that we think don't make any sense. But I saw the Goldman Sachs boss interviewed. Did everyone see that? I'm sure you did, a few weeks ago, where he said, 2.5 billion to us is small change. I was like, what? That's how it works. But Goldman Sachs have already been pulled up the last few weeks for, again, this is on the BBC News website a few weeks ago. By the way, I didn't put the picture of the shark in there. That was a revolving advertisement, and as I took the screenshot, I didn't realise the significance until I put it in my PowerPoint. But I think it's quite amusing. But we talk here about, banks that are in the news, institutions that are in the news. But what is it we're going to get from this? We are going to give you an edge. That's what you're going to get from this. An edge that the majority of the public never see and don't get. You don't see many educators up talking about this stuff. Do you know why? Because it's a little bit controversial. But if you want to make money in the stock market or any market, you need to wake up and say, yes, let's be open-minded. Your mind is like a parachute. It's much best used when you open it. And we've got some traders in here. I see Earl over there, one of our long-standing customers who's been to several of our seminars. And I've got a little story to tell you about Earl shortly. So the connection between all those individuals and everyone in this room, David, Gary, Rob, Paul, myself, and all of those individuals that I've just mentioned, maybe excluding Lucky Luciano, the reason that we're connected is we want to help you to become informed and to help our fellow human beings learn how the markets operate. And that is why we have with us a group of individuals that want to help, and through this weekend you're going to see we've all got a lot of knowledge that we want to impart to you. What is our objective? The objective, I think, I did a list of 25 things and then I dumped them. I put them in the bin. Because actually, it's simple. To learn how you, every one of you, can profit by understanding why markets are manipulated and how to identify those footprints on a chart to trade in harmony with the manipulation. And that's what this is all about. This is not about the Andy Maguire conspiracy stories out there. This is not about, oh my goodness, the SEC and all of this and the CFTC are in on this. Look, this is nothing to do with that. This is simply human nature we're dealing with. It's been around for 200 years or more since the tulip markets were invented. In Tom Williams, when I first met him and he told me about this, and I'm an ex-police officer, so it takes a bit of investigation to convince me about anything. And I do investigation on anything that I see, and due diligence, as we call it. And when I did my due diligence on Tom and his work, what came out of it when I met a trader in the United Kingdom, who I won't mention the name, but he was a very large trader in the city. I gave him a copy of our software. And I said, look, I'm thinking of buying this company. I said, but I don't know anything about the markets. This was several years ago. I said, and I'm thinking of getting involved with this. So he said, leave it with me for a couple of days. I'll put it in one of our prop funds, and we'll actually give it to 2 or 3 of the traders. 2 days later, he called me back. He said, Gavin, buy the company. You've got to buy the company. You've got to take that over. He said, because if you can get what you're teaching out there, he said, it's not going to be easy, and I can vouch for that. He said, because what you're going to teach isn't just an easy solution. It's not easy, but it is simple. Making money, as we all know in the markets, isn't necessarily easy, but we can, with proper discipline and processes and setups, be profitable. Now, this was a recent email that I received. I know the person's in the room, the internet room, listening, so I'm not going to say the person's name. They've asked me not to. But Gavin, it says, can I really be a successful and constantly profitable trader? There's so much snake oil in the trading business. I have spent well over $50,000 on courses, books, and joined several so-called live trading rooms where the actual educators never trade a live account, just a simulator, and that simply is not real. I have tried just about everything, and this is a last resort, because I've not made any profits for 5 years. I've been following your work, and that also of Rob Hoffman, who was in the VSA Club recently, and you're trading real money in real time on what is obviously not a simulator, which your broker confirmed when I checked. I was sceptical initially. And you're obviously both very successful. Do you have some secret that you are not revealing, or can anyone be trained to do what you guys do? That's a great question. Do we have a secret? I mean, one gentleman rang me in the office many months ago and said to me, Gavin, I saw your oil market video. He said, you nailed it. How did you do it? And he said, can you tell me, so I'm just about to put a position on, where's oil going to be in 6 months? So jokingly, British sense of humour, and you know, Paul, we have a British sense of humour, and sometimes it goes above people a little bit, but because we're a bit sarcastic. But I said, I'm going to look at the trade guide, a crystal ball that Tom Williams gave me. And it went quiet, and he said, you use a crystal ball? And I went, I'm joking. I said, that went straight over your head. And he's like, and then I explained to him, I said, no, I said, you've got the solution to looking at what the oil market is. It's in there, and it's on the chart. That's all it is. That's all I do, is read the charts. But then I said to, this is quite a new slide, because Earl, if you'd like to stand up, this is, ladies and Mrs. Earl Ehrenler, and he's a trade guide. I know you can't see him. I don't know if, Richard, you can put the camera on Earl briefly. But basically, Earl, I met Earl, 2 to 3 years ago now, and yeah, it's a while ago. And Earl's a guy, a customer of ours, who came in, and he wanted to learn how to trade and be a successful trader. One thing about Earl was, number one, he was prepared to invest in his education. That I could tell about him. That's why he's here again at yet another seminar. Number two, I could see he's a disciplined guy. You can see straight away when you talk to people, they've got a disciplined mentality. But there's also another trader out there called Tim Raymond. I don't know for those of you who have heard of Tim, but Tim Raymond, just so you know, won a competition. Now, let me just change the camera just for a second here. And I want to go quickly, if I may. And the reason for showing you this is there's one part of trading and investing that very rarely gets talked about. This is Tim. Can everybody see that on the internet? I should be broadcasting that now. Yeah. This is Tim Raymond. Okay. He's, I don't know if you've heard of Tim. He was one of the top journalists for the Times, the Sunday Times. He's an investigative journalist. Now, why am I showing you this? Do you know something? There's one thing that makes a successful trader. And it's not maybe what you think it is. There's one thing. Anybody got any ideas? What? There's one key thing about successful traders. Anyone got any ideas? Who said it? Sheehan had to say it, yes. Belief, the B word. Belief in the ability to be successfully as a trader. This man here, walking down the aisle here, Mr. Hoffman, believes, and every day I see him consistently making winning trades. He has belief. I have belief in my ability. What we want you this weekend to take away with is you all have exactly the same as I've got and Rob's got. You all have the same ability. But the question comes when you sit at that computer to pull the trigger, do you believe you're going to make the winning trade? Or actually you're thinking, I'm going to lose again, I'm going to lose again. And guess what happens? By natural process you lose because you don't believe. But Tim Raymond, actually, he went on a journey and he had a whopping 44% gain to win the World Cup Trading Championships. Okay, now this is just a normal guy trying to learn to win in the markets and to be consistent. So just like Earl over there, he fortunately was very lucky. And I won't read the whole article to you. If anyone wants this article, by the way, it's on our website on the front page. I'll just read you this top line here. It says, in 1998, Raymond had the good fortune to connect with Tom Williams, the creator of volume spread analysis. I rang him and he was very reluctant to sell me his software, he said. Trading's very difficult, you know. I insisted and agreed I would pay £5,000 in instalments. These days, if I'm asked by someone who is starting out in trading for advice, the first place I'll say to them is to Trade Guider. For me, it demystified the markets to a great extent. Okay? And Earl, congratulations to you, because I actually can see, if I look here, during February here, and in fact you were, there you go, there's Earl's name just there. Can you give a round of applause to Earl? I think that's and
it's also for January 2.
It's January 2, yeah, as well. And I'd like, at the end of the year, December, you're going to win, correct?
I hope so.
No. You are going to win. What's the word? Belief. But that's a great success story. That's it. So if Earl is out there doing it, and by the way, just so you understand what this is, if you see Mike Panici, Mike will tell you, and it give you, they run this. Mike, I'm correct. Real trades, real money, real percentage. No messing around. This is published, and these people are trading real cash, correct?
Correct. Every trader trades under exactly the same level playing field. Everybody pays the same commissions and
So it's a level, what Mike's explaining for the internet, he's saying it's a level playing field. Every trader has the same things, and they publish the results every week to show you.
they have their own trading strategy. They can trade whatever they want. And PFG best monitors and tracks every trade they make.
Brilliant. Okay, so therefore I hope that shows you that, you know, and Tim Raymond, just so you know, he was the winner for the whole year with, there's the 2009 results. So, ladies and gentlemen, please understand you can do it. And at the end of this weekend, you're going to have the tools to know you can do it. Anything is possible. Believe it or not, if you looked at some of the comments 200 years ago about human achievement, there was many comments about, we'll never do this, we'll never do that. Who would ever thought we'd be on the moon? Whoever thought you'd now have an iPod or an iPad that does all those things 10 years ago? Always believe that something's achievable, and it will be there. Okay, so we've already talked about market manipulation. There's plenty of stuff. Go to market, easy thing, rather than dwell on this, go to Google, just type in market manipulation, find out for yourself. Knowledge is power, due diligence is power. So are the markets random, or can news be used to drive the herd? Some very good examples to come. If you don't read the newspaper, you're uninformed. If you do read the newspaper, you're misinformed. Mark Twain. Thought that was a good comment. The markets work because human beings have two powerful emotions they have difficulty controlling: fear and greed. The market has to be fed losers. It's devious. And what you will hear will often not be the truth. I've never heard the truth about the stock market or any market on television. Just look at the news about the oil market in May 2008. Greed at the top, as many traders piled in because they were told oil had to go to $200 a barrel. Do you all remember that, by the way? Everyone? Raise your hands. Do you remember? I'm just sometimes we forget. But try and take yourself back to that time. Gasoline was $5.50. All these things were going on. But as Tom says, the chart never lies. And I actually went on YouTube to show the end of a rising market. And then you just look at the banking sector in 2008 during September. Fear setting. And professional money began to buy, not sell. And that caused stocks like Goldman to rally. Well, now it's 400%. It was all in the chart, if you know what to look for. And that was from Tom Williams, who's going to be joining us tomorrow. And there's two very quick examples. Some of you have seen it, and I've corrected that slide. Goldman Sachs went up to 400%. But I've got a very recent example of something that we can show on the chart. And then I'm going to bring Paul and Andy in to talk a little bit more about the subject of market manipulation and how we can all profit from it. So we've all seen this, I think. Some of you, the new people, may not have seen this. But this was an oracle of oil is predicting $200 a barrel of crude. Okay, and it was May 2008. It was Arjun Murthy was actually this particular headline, but several others were also predicting this. But he was an analyst, in fact, at Goldman Sachs, would you believe? And, of course, the news then infers that we're going to see this. Even some of the big airlines got caught out here, by the way. Southwest was the only one that didn't. They must have had somebody on the inside, but whatever. They didn't. But this was the YouTube video that we did, and I'm going to show you the chart pattern and what it looks like now. And what it's now. Can I ask the audience? In fact, I'll ask this on the internet, Rob, if you can. How many of you remember me talking about the sugar market falling several months ago and being manipulated? Did anybody remember that? Who's been in our seminars in here? No? Just a couple of. Okay, you do. Yeah, a couple of you. Okay. I know sometimes you haven't been in my seminars, but is there anybody online? Yeah. Okay. So. Now, that was a forecast that I was very comfortable to make, and I made it back in August of last year, and then gave the setup on a chart, and exactly what I said has happened because it has to, because of the forces of supply and demand. This is what happened, and I want you to look very carefully there at the widespread down on that bar. Now, look at the volume. What do you notice about it? Keep going. Come on, tell me. What is that volume? Low, high, ultra high, very high?
Ultra high.
It's massive. It's massive volume. And look at the closing price. Does it close on the high of the low of the bar? And where does the next bar close? Up or down? And that's a 2-week thing. Now, we know sometimes we teach you that strength appears on down bars. This is the exception to the rule. After a bull run, where you'll see weakness in the background, professional money use a manoeuvre to catch stops and then get everybody that's long put immediately into a poor position. And this is how they do it. And you'll see it produces a trade guide or indicator there, which we'll talk a lot more about. Let's talk about something in the news now, and let's show you that sugar chart briefly. We're okay for 3 or 4 more minutes. US regulators fined Morgan Stanley $14 million for failing to report a big block oil trade, and fined More Capital $25 million for attempting to manipulate palladium and platinum futures. The story goes on. We can talk about that one in part 2. But this is actually what was said, and I just want to highlight for you a few things here to start to get you to understand where we're going with this. For failing to report a big block oil trade, why would you fail to report it? Can anyone think of the benefit of failing to report it? Anyone?
Because whatever way it went is probably the trend alignment, and it's probably going to continue going that way, and they just want to exclude information from it.
Partially correct, and that's a good answer. Definitely. The other reason is, when you put big block orders in all at the same time, and all the banks do it, what happens to the chart? Anybody got any ideas? What happens to the volume? What happens to the volume? Why do you think the exchanges don't want the volume released till the next day? Think about it. If you can read it, you can trade in harmony with it. Now, here, it says the firm neither admitted or denied the charges, said according to the CFTC. But I want you to look very closely at the date. You see that date? February the 6th, 2009. You all got that? Okay. So let's take a look at the chart, and we'll see if we can spot Yao Ming anywhere. Anybody, does we all know who Yao Ming is? Raise your hands. Yeah, he's a basketball player, correct. So the analogy here is if an alien landed and asked me how tall I was, and they'd never seen a human being, then you'd need to give the alien a comparison, just like looking at volume. So Paul, could you stand up a second? if you wouldn't mind. So this is Paul here, and I'm about probably is he taller than me? Yeah. All right. So he's a little bit taller. Let's say I'm high volume. He's high volume. Okay, fair enough. So now, if I had Yao Ming standing next to me, what would Yao Ming be? Ultra tall. In fact, would he stand out in the crowd if he was in this room? You agree? Okay. So I want you to ingrain in your mind that what you're going to be looking for here is Yao Ming bars. Okay, and we're going to look at those here. This is the very same chart of the crude oil contract. All right? I've highlighted with the vertical red bar, okay, the day of the block oil trade, 6th of February. What do you notice about that volume? Spiky. It's Yao Ming. That's bigger than Yao. Actually, that's Yao Ming's higher than Yao Ming. Now, that's the very same day that JP Morgan tried to withhold their order. But you can't hide it in volume if you can read it. If you can see this footprint. Now, there's a trade setup here I'm going to show you in part 2, and Paul and I will show this, which is what we call a climactic bar followed by an immediate test. And it's very, very, very bullish. But I'll tell you this, the news on that day will not be bullish. It will be bearish. You will see the commentators on CNBC all looking very glum. Oh, this is oil's going down to 15. Oh, there's a load of tankers stuck out there. I mean, all the news. Tom rang me on that day. I remember it well. And there was news, and it was very bad news. All the tankers were being held in a line outside in England because now they've got too much supply. There's too much oil in the world suddenly. But hold on a minute, 2008, there wasn't enough oil. Make up your mind, people. Which one is it? Have we got too much or none? Well, it suited them to print this thing that suddenly they found new wells and they've got all these ships. They used that news to buy back the contracts they sold at 147 for a very nice profit. Thanks very much indeed. And guess what? Do you think there's any accidents in the markets? Do you think they're all random? Look at the date of the next big volume spike. It was a year later, almost to the day. Now, there's no accidents. And again, it produces a trade guide, a sign of strength. So remember, when strength appears on a chart, it will appear on a down bar, not an up bar. Don't chase a rising price. Correct, Rob? Right. You'll always see Rob trading and I trading. We're looking to trade the trend, and we're looking to buy on a down bar in an uptrend. There's two types of bars that we're going to look at in the second section. And it's the opposite in a downtrend. You sell on an up bar as the market's going up at the top of the trend channel. Just stick to those rules and you'll be getting in at the market at the right price. So here we had, and this is one of our indicators, Paul, on here. This is what we call stopping volume on that bar, which was then followed by a low volume down bar into that area, which we call a test. And then where we buy that market, whatever it is, we buy the market after it has broken the high volume widespread bar down. As it takes out that top bar, you buy it as it dips down and tests it. And then again here, we see a very strong potential sign of strength called a climactic bar. So basically, it's easy to look at all of those things in hindsight, isn't it? Every educator does that. Oh, well, this is what happened there. So let me give you something that's happening right now. Now, I've been forecasting it for a long time, and I still think we've got an opportunity on this particular chart. Now, watching it, it was August the 13th, 2009. If everybody can see that. Food firms warn of sugar shortage. That means it's going to create, okay, a level of activity for professional money to take advantage of. Because, of course, if there's a shortage of sugar, what will happen to the price? What will happen to the price? Go up? Has to go up. Because that's what... Now, they know that, so they've obviously brought some of the sugar contracts lower. They need to try and sell it at premium value. This is where the operations of the herd come in, the herd mentality. Because you see this, and actually the price keeps going up. What you never want to do is buy, though, on a rising price. You've got to remember that weakness will appear on an up bar. Now, everyone wants to know when to pick a market top and pick a market bottom. That's what most traders say. I'd love to do that. It is possible to do it. But the day you see this stuff happening, you won't believe it, because the news will be inferring something different. But in 2006, the same thing happened. There was a story of shortage of sugar. This time it came from Pakistan. They wrote an article on it here. Again, well played by profiteers. It was. And surely we now see this is exactly what happened, and I'd like you to look at this very carefully. The market went up and up and up, and as it got to the top of the line here at $20, we noticed the ranges or the spread of the bars. Now, when we talk about volume spread analysis, we're looking at volume at the bottom of the chart and range and spread. Then we're looking at the closing price after we've seen weakness appearing on up bars. As we come down, every week we form a down line at the top of the channel, and that is where you enter, or on this bar, where you see lower volume into that same area on a narrow range bar. That, after you've seen serious weakness, is a very strong confirmation. Now, you haven't got this PowerPoint in your things, but I will get this printed for you because I added some stuff to it. But we will also upload this to the website for those of you that haven't got it. So now I want to bring in our keynote speakers for this morning. I think, Andrew, I think you're there. I can hear your mic on. Good morning. How are you? You sound great. Hello, Andrew. And I've got Paul with me here, who I'll bring in here shortly. We've got a great audience here, Andy, live here. I know you can't see them at the moment, but the way we're producing the video on the archive, you'll be able to get a feel for who we are.
That all your viewers might be interested in. Keith asks, I seem to recall that all physical attendees will receive a copy of the recording. Will the same be for the webinar attendees? Will they receive a physical
Yes,
copy?
they will.
You want to let them,
Absolutely, yeah. So, ladies and gentlemen, I'm going to bring in Paul here, and we'll bring in Andy. And then what we'll do, for those of you in the room that want to come and listen if you can't hear, we're going to run it through here. What will need to happen when you've asked Andy a question, if you just mute the mic here, just on the green thing to click it so we don't get an echo, and then everyone should be able to hear us.
yeah, you still need to repeat that question back because only the one person knew what you asked. What I was asking.
Yeah, sorry, the question came in on the webcast. They said, will people in the webcast now get a copy of the recording with the video and everything on there? The answer is yes, you will, which is good news.
And one other question, are there any materials to download now during the presentation?
Yeah, they're up on the site, aren't they, Richard?
Not yours.
Okay, now mine isn't on there yet, but the rest of them will be when we get to...
Up there now.
Okay, they're up there now. Okay. All right, so let me... I'll put your PowerPoint up for you. Shall I? Okay, just bear with me a sec, Andy. I'm just going to bring Paul's slide up here. Okay, so ladies and gentlemen, let me introduce you to Paul Coughlin, and once we start to bring Andy in, we'll just do a quick sound check just to make sure it all works.
Sure.
That's okay.
Will I be able to hear him?
Yeah, certainly. We should be able to. What we're going to do, that's got quite powerful speakers, so we should be able to hear it. But if not, as I said to the audience, do feel free to come up and stand here. That's not a problem at all. It'll be fine. So, ladies and gentlemen, big round of applause for Paul.
So, I'm unmuted at the moment.
Yeah, you are. You're unmuted, so everyone can hear you, and you just click that to mute. Hold on. You can now. Yeah.
And why do I need to mute it?
Just so there's no echo if we're putting it through here when Andy speaks.
Okay, so when Andy speaks.
Just when Andy speaks, yeah. And then what I'll do is I'll turn this round. Cool. So, in fact, if you ask Andy now to do a quick sound check, and then we'll just mute that, and I'll put this up.
Okie dokie. Andy, can you hear me? Cool.
Okay, so just go to count to 10. That'd be great.
Andy, can you count to 10?
1, 2, 3,
Hear that?
4,
That's okay.
5, 6, 7, and I just shorted 9 and 10.
Sure. Oh, no, does it need to?
Are you using those speakers?
Yeah, we're using these ones.
Oh, right.
Okay. All right, we're good to go. So let me just put that on mute. There you go. And whenever Andy speaks, I'll just unmute him there.
Okay.
Yeah.
Hello, everyone. No one here has a clue who I am, why I'm standing here, and I'm starting to wonder myself. So,
First of all, I just want to explain, I guess, who I am, and Andrew, who's my partner, who Andy is. In fact, you've heard something already in relation to Andy. I saw some hands up earlier on this morning. Some people are already aware of Andy's activities in relation to the silver and gold markets, more specifically silver, but generally the metals markets. My own role, I'm predominantly a currency trader. I provide analysis and trading in relation to the currencies. Andy focuses specifically on specialist metals, so he'd be looking at COMEX silver, COMEX gold, and together we work within Coghlan Capital. Website, if anyone's interested, is coghlancapital.com. I'm going to be here all weekend. We're going to try and cover a lot of ground basically in the next hour, and then I think after a break there's going to be an opportunity to go through some charts. For this first session, we're going to try and focus predominantly on the metals. And then after the break, maybe talk a little bit about the currencies. But just so you know, I will be here all weekend. I'm going to be here this evening, tomorrow night, and I'm very happy to sit down and chat with anyone, any topic you want to talk about. So I guess, as Gavin was saying this morning, this isn't so much, my God, there's manipulation, oh, isn't it terrible, we need to go straight to the hill and complain. Look, the only markets that there are manipulation in are the ones where you can make or lose money, i.e. all of them. There's always going to be manipulation of some form. So it's less about there's manipulation and it's more about, let's call it management of the market. That's what I keep hearing. It's a managed market. So how do you know that you have a managed market and how can you make money from that? Oh, okay. So this is really, really brief. I don't want to spend too much time talking about are the metals manipulated. I know there's this derogatory term that I know some people use, which is gold bugs. It's like, well, if you're bullish gold, you're a gold bug. And I keep hearing people specifically on some of the media like CNBC saying, oh, God, the gold bug's read it again. They're talking about $5,000 gold. I'm not a gold bug. Andy is that absolutely not a gold bug. I happen to know that, in fact, I don't know whether it's still the case, but I know within the last week, in fact, Andy was very happy to be short gold. So just because we might have a strategic long-term view, which is that the metals will increase in value, we're very happy to make money as much on the downside as we are on the upside. If we see manipulation or if we see footprints in the chart that tell us that we're about to see a move down in the metals, there's absolutely no need to ride that move down. We typically step out, step back in at a lower support and ride it back up again. So I just wanted to very briefly explain. Look, I'm not going to read this because, A, you guys can see this, and I'm guessing everyone on the internet can see this. It's pointless me just reading it to you. These are obviously, everyone knows Alan Greenspan, everyone knows Paul Volcker. These are statements that were made by these guys. There is management in the price of gold. If any of this is confusing, just like raise your hand. But basically, there is an abs.
I can ask a quick question for you, just what you said. You mentioned something about all the markets are manipulated.
Yes.
Would it be fair to say then, you've got stock traders in here, you're talking about metals, but the very same principles that we're talking about in the stock market, or sorry, the gold market, would apply to stocks and also to commodities and everything else?
Yeah, I mean, in fact, I was going to put a farcical slide in my PowerPoint, which was along the lines of, on the next slide, I'm going to give you a comprehensive list of all markets that are manipulated. And then on the next slide, I was just going to say all of them. Everything is manipulated to some extent. And if you don't believe that, well, you probably shouldn't be trading. Everything is manipulated. And this is something I'm just very briefly going to go on to this and then carry on. I don't want to get too sort of sidetracked, but I've got so much I'd like to kind of get out, and we only have like an hour. Here's something, though, you need to be really cautious of. If you're bullish a vehicle, let's just say you're bullish gold, you think gold's going to go up. That's really, really dangerous in intraday or scalping trading. If you bring a bias to a chart, it's suicidal, absolutely suicidal. And probably a good example is this. If I was to put up a chart of gold or silver and say to people, right, let's try and find a trade, whether you admit it to yourself or not, I guarantee that most of you will be saying, right, let's try and find a long entry. Because the bias is the metals are going up, it's a bullish market, we're going to try and get long this. Irrelevant might be the fact that the chart is indicating that it's rolling over and we're about to see a move or a consolidation back to the downside. Equally, if we put up a chart of the S&Ps, the E-minis, I guarantee most people are going to be looking for a way to get short the S&Ps. Now, I'm sure there are some people out there saying, well, no, actually, I would try and get long. But my point is, everyone typically brings a bias to a chart, and it's suicidal. So you need to be kind of cautious. I mean, I'm happy to talk about a lot of this in more detail offline, but just one example there at the bottom, Gordon Brown. I had to add the word former in the last few days. Gordon Brown was the former British Prime Minister. He was basically, in fact, Andy, what was his exact title back then? Treasury, head of the Treasury?
Yeah, he was, yes.
Okay, so he was head of the Treasury in the UK, and back at a time when, if anyone knows long-term capital management, when long-term capital management were basically, how do I word this politely, they were in some trouble. They were short 400 tons of gold in a rising market. They were on the verge of going under. The Fed had to step in to supervise a bailout of LTCM, and just slightly after that, the British Prime Minister, former British Prime Minister, head of the Treasury back then, did something very, very unusual. Not that he sold 30% of the British Federal Reserve, he announced it. He pre-announced that he was going to sell 30% of the gold, which, by the way, was 415 tons, which is what LCCM was short, and there was a desperate requirement for that physical metal. So, and I know Andy's going to talk a little bit, maybe a bit more about this, but basically what happened was he depressed the price of gold and then sold. There was absolutely no sense to this happening. And at the time, there were a huge number of articles talking about why did this happen? Why did he sell at, and I think it was around $290, but why did he announce it the day before? And why was it that UBS put out research to their clients the evening before the announcement saying gold will not break $290 short gold? And then following morning, out comes the announcement, we're selling 30% of our reserves, and down goes the price of gold. So there are dozens of examples of it being a managed market. Can you hear him?
No.
And Andy, can you hold on? I think Gavin's got a technical issue.
Go.
Okay, you can go now. Andy, you can talk now.
Yeah, can you hear me?
Yeah.
Yeah, we can hear you, Andy. Andy, we can hear you.
You can hear?
Yes. Yes.
Yeah. There's a delay over the internet of about 3 or 4
Yeah.
Yeah, I was just going to add one thing there.
Yep, shoot. Andy, you can talk now.
Okay. Yes, I was just going to add one thing there. Under the Freedom of Information Act, we and a number of other people, including the Daily Telegraph newspaper here in the UK, had been suing for that information, and there was a court order issued for that information to be released at the end of April about how that gold sale came about, the relationship between Gavin Davis of Goldman Sachs, and also the relationship between the former president, former Prime Minister Tony Blair, who currently, by the way, works for JP Morgan. The relationship between all of that, and the Bank of England had come out and actually stated that they were against the gold sale, even though Tony Blair at that time had said that they had agreed to it. So that suddenly became a subject under the Official Secrets Act. So very strange, but anyway, I'll let you carry on.
Thanks, Andy. Yeah, we're actually going to hear a lot from Andy, especially once I get through probably like the next 1 or 2 slides. Andy has a ton of experience. But let me just finish off these last couple of slides. So hopefully people at least acknowledge that, yes, the metals markets are managed, manipulated, whatever you want to call it, or shenanigans, I think was, as Gavin said. Well, why is that? And there are 2 pretty simple reasons, actually. Number one, Governments don't like to see gold strengthening too much because it makes national currencies look weak. And so basically, it's basically a simple battle of gold versus fiat currencies. And so what you'll typically find is that when there are treasury auctions, for example, we're going to talk about this in a while, but when you have especially 30-year treasury auctions, you'll typically find that gold will weaken into that treasury auction. And it's for no other reason than gold does not, they don't want gold to look too strong going into a treasury auction because effectively it's competing with the currency. So do you want gold looking strong going into a treasury auction? No, you don't. Secondly, and I'm going to show next chart, there are some companies, and maybe Andy will mention who they are, but there are 3 or 4 companies that are massively short silver and or gold. And I think the last number I heard, and again Andy might clarify this, is for each dollar that silver rises, this one particular company are in the red $1 billion for each $1 that silver increases. So it's definitely not in their interest to see silver rise. And the next chart is probably a really good, in fact, I will mention it because it's on the next slide. Now, I don't know how clear this chart is. In fact, it's not very clear at all. So let me just talk through it really quickly. Silver was in an uptrending market. And on March 17th, 2008, it topped somewhere around wherever it was, like $22, $21.80, somewhere around there, it topped. March 17th, 2008 was the day that JP Morgan took over Bear Stearns at $2 a share, and Bear Stearns were massively short silver. JP Morgan took over the Bear Stearns short position in silver, and that is the exact day that silver topped. Over the next 9 months, it dropped 61%. Now, if you think that's a coincidence, I have a bridge to sell you. That's absolutely no coincidence whatsoever. It dropped way below the cost of actually producing silver. And in case people aren't familiar with the facts, silver is a more precious metal than gold. If you think about it, an ounce of gold that was mined in the year 1900 probably still exists. It's someone's ring, someone's chain, it's in a piece of jewelry. It doesn't get consumed in the way that silver is consumed. An ounce of silver is put into circuit boards, it's used by industry, it's actually consumed, and it's used in such a way that it cannot be easily reclaimed. So the number of ounces are basically diminishing at a pretty high rate. So JP Morgan took over this short position back in March 08, and by November 08 we were down around $8 an ounce from nearly 22. Obviously, now you'd think, well, that's great. What they did was they brought it down, managed to cover all of their shorts at a great profit, and then allowed it to go back up. Andy might refer to the fact that, in fact, not only do they still have a short position, their short position is larger than it was back in March 08. They've increased it. So silver especially is an incredibly volatile market. It's a managed market, and to be quite honest, if it's not a market you're particularly au fait with, it's really not one to try and cut your teeth on in terms of trading, because even in the last 2 weeks, you may see, I think it was like $1.50 to the downside. I think it went from like $19 to like actually just over 17. It was like nearly $2 move down in like 2 days. And some of what I'm going to talk about a little later when we start looking at chart patterns, and I kind of wish I had a little laser or something here.
You can use the pointer
but,
here, actually.
oh, I can?
Yeah, there's a pointer so the internet can see it.
So
you
cool.
can point at
So,
everything on there.
so in fact, Gavin was talking about manipulation, and actually I want to explain one thing. This weekend is the best of Wyckoff. I feel a little bit like this is a Ferrari show, and I've turned up in a Lamborghini, because the methods that I use and Andy uses, it's not Wyckoff, but I think there are a lot of parallels in what we do in comparison to the Richard Wyckoff method. Andy and I use median lines, action-reaction lines, and a lot of the methods that we use date back actually to the third law of motion. For each action, there's an opposite reaction. And in fact, Roger Babson in the early 20th century was using these methods to great effect. There is a wonderful chart by George Marischal, which in fact I will show later in this presentation, which shows just how accurate some of these methods are. But we also apply common sense.
Paul, can I ask you a question just quickly? If you
Sure,
can
sure.
repeat this to the audience. The metals markets, we see when there's a big move in gold, it often comes into the currencies in some way, shape or form. Is that linked in any way, the currencies to the gold market? When it's moved on the
Okay,
surface?
so Gavin has basically asked me whether there's any connection between the currency markets and the metals markets. And here's how I would describe it. I keep hearing people say, oh, there's a correlation between gold and the Australian dollar. There's a correlation between oil and the Canadian dollar. They're commodity currencies. Yeah, there is a correlation. But you know what? A correlation doesn't mean they're married. It just means they date. You know, every once in a while, they'll go in sync. Other times, they'll go in opposite directions. And I see, like, the dating reference. Sorry, is there a question?
You just stated that, okay, Morgan Stanley took over Bear Stearns. Bear Stearns had a large
JP Morgan, yeah.
position in silver. To clarify, you have to say specifically or about approximately where Bear Stearns got in silver short, because at a 22 all-time high, it was a perfect time to short silver. Correct?
Okay, here's how I'd respond to that.
You want to probably just repeat the question?
I'm sorry. In fact, the gentleman...
It was just a statement, but I mean,
Oh.
if you look at this chart, when you said, all right, they took over Bear Stearns and they had a massive short position in silver, at that precise time is the time they go short silver.
Okay, let me just repeat what someone's just said. A chap in the audience has just said, if Bear Stearns, and tell me if I get this wrong, if Bear Stearns had a massive short position, well, that's fine, but where did they get into it? And surely once silver had reached nearly $22, obviously that was the perfect time to short silver.
Right.
And here's my response. Why? Why could it have not gone to $30 or $50 or $100? The problem is, this to me is the inverse of picking or catching a falling knife. The inverse is, well, why can't it go to 25 or 30? I mean, it's easy to look at that chart now and say, in fact, that was the perfect time to short silver. Well, yeah, because we've got like 100 bars after the high, so we can see that. But you know what? When it's doing that, unless you're using some methodology such as the Wyckoff methodology or market geometry, which is what we use, I'm not so sure it's that obvious that that was the time to short silver. And the fact is, a lot of... You're going against the grain. And like I say, it's the inverse of catching a falling knife. When oil hit $100, people were saying, oh my God, like now's a great time to short oil. It's not going to break 100. Well, you know what? It went to 147 or something like that. So I'm not sure it was really that obvious a place to short. What's very telling is that, hopefully it's very telling, looking at that it dropped 61% in 9 months. And even down in the $8 area, they were building their shorts. I mean, what are they expecting? 0? Where were they going to cover their shorts? When it went to -2? Or they went for a minus number? And in fact, they've grown the short position, and they've grown it the whole way up.
Do you have a question, Gary?
Hang on. Yeah, Andy, he was talking
What
about...
we're doing, whenever he needs to talk, if he just lets you know, and then we'll just switch your mic off and bring him in.
Yeah, Andy, you probably didn't hear that, Andy, but just so you know, I think there's some technical issues. So if you need to say something, if you just say, hey, Paul, can I cut in here? And then I think Gavin actually has to turn your microphone on.
It takes about 5 seconds.
It takes about 5 seconds because there's like an internet delay.
Yeah.
But one thing I just wanted to point out, which is Gavin was talking about how psychology, in fact, I don't think you used the word psychology, but obviously that's what he was talking about when he was saying human nature, fear, greed. Psychology is one of the largest parts of trading the markets. And I just wanted to show one particular thing on this chart. You've all heard of breakout trading. You know, you break a prior high and get long, and normally you get a certain part of your anatomy handed to you when you do so. I just wanted to show you this high here. And hopefully people on the internet can see this. But I think what you'll find is, and I'm just looking at this high took out the very obvious high here. Everyone got long because we'd just taken out a very, very significant high. And what happened? Straight down. In fact, it was a really big move down. We went from, let me have a look here. It went from like $19.50 down to like $14. So it dropped $5 after taking out a prior high. That's not accident. And the reason that the powers that be want that, they actually want the prior high to be taken out. They don't typically want to prevent it. They want it to happen. And the reason is they know that when that happens, all of the retail traders are going to say, oh, great, we just took out the high. Get long silver. So everyone jumps onto the long boat, and then they bring it back down. Now, the problem is this. They're not going to get the great speed they want on the way down if everyone's on the sidelines watching it, because everyone that's on the sidelines can just watch it go down. They want everyone on the wrong side. They don't just want people on the sidelines. They want them long, because it's when they're long and silver's moving down that everyone's freaking out and saying, I need to get out of my longs as quick as I can. And so everyone's hitting the sell button. So they actually want people on the wrong side of the road. And that's exactly why this happens. They'll take out a prior high, reverse it, and spike it down. Again, I'm happy to talk about loads of charts a little later on. This is where I kind of want to bring Andy in to talk a little bit about, okay, it's a managed market, and again, we're not talking about conspiracy. What we're talking about is, well, that's great, but how do I make money? Because, okay, I'm a big believer in having great charts is just one aspect, but you know what? I haven't yet found a bank manager that will allow you to walk into the bank with a really cool-looking chart and deposit it into your account. Charts actually don't pay the bills. Trades pay the bills. So having great charts is one thing, but unless you can execute trades based upon those charts, it's kind of irrelevant. We're not here to be chartists, or at least I'm not. I'm here to be a trader. And so for me, charting is purely a means to an end, and the end is making money. So,
That's exactly it.
yeah. So and I think sometimes we kind of forget that, and it's all about the chart. Well, you know what it is, because the chart is a tool, and you want to have great tools, but you're only producing the charts and the analysis and the resistance and support levels for one reason, to make a trade. So that should be the absolute focus. Let me bring Andy in now to talk about some of the times you can actually get those trades based upon what you're seeing on the charts. Andy, as I said, he is predominantly, and it's kind of unfair to say he's just a metals trader. He's not. Andy trades currencies as well, but he does specialize in gold and silver. He's probably, shall we say, a fairly well-known trader at this point. But I think the focus this morning is less upon that and more upon his experience and skill that allows him to pick out some great trades. So Andy, I'm actually going to, we're going to try and, we thought we were going to try and do this as a two-way thing where we bounce backwards and forwards, talking about opportunities and going through charts. We'll see whether the technology allows that. But for now, let me bring Andy in. Can you hear me, Andy?
Yeah, I can. Am I coming across okay?
I've got it. Wait now.
Yeah, you're fine, Andy.
Yeah, you're fine, Andy. Okay, I guess there's a bit of a delay, so anyway, so as long as you can all hear me, Paul's gone through, why gold and silver, basically why they're manipulated, and we've only got a tiny amount of time today, so it's a really big subject. So let's really focus on an immediate opportunity that's presented itself in silver at this point. And obviously, we'll discuss gold and silver, but it's due to this massive short position that's been built up over several years that's recently come under attack. Now, obviously, a little more background, and very quickly. Going back to your previous chart there, Paul, where we discussed the collapse of Bear Stearns and the J.P. Morgan, who basically J.P. Morgan act as agents for the Federal Reserve, and were assisting in that bailout. So if one goes, the clear evidence is, there's obviously a lot of questions about this, but the clear evidence, if you go to the CFTC's own bank participation reports and you go back to July 2008, you will see that the total short position held by two US banks was 4.8% of the open interest, with 6,100 contracts short. The non-US banks were all long. They've really very little short positions. If you then go to the very next month, August 2008, suddenly we jump from 4.8% for these two banks short to 25.4 in 1 month. So it jumped from 6,000 contracts short to 33,800 contracts short. Now, this was not just a straight assumption of a short position. This was leveraging a position and leveraging it many times over. And really, there is a fiduciary responsibility when one has a collapse of a bank. Really, if you're going to inherit a position, a metals position, and you were to neutral hedge it, which would be an acceptable thing, you should really have no net effect. But you can see that what happened was that they added, and this is based on the Bank Participation Report by the CFTC, clear evidence, it jumped an enormous amount in 1 month. That's unprecedented in any other commodity. Now, fast forward to this last month's report, which is May. What we have here now is the same two banks, and although they've, by the way, the CFTC have stopped listing the number of banks because there was requested that they wanted some kind of anonymity, but we can identify them through the Office of the Comptroller and the Bank of International Settlements data. This position is still 34,427 contracts as of May, which is nearly 28% of the entire position. So instead of just covering those short contracts in that takeover and covering it into the from the $20 drop to $8.50, none of those contracts were really covered. So essentially, this concentrated short position has been maintained ever since. And I think that's one of the reasons that, that this whole, my complaint to the CFTC, as many other people have complained, and there are many people that have complained, really that's what the subject was about how can any one single banking entity, or even two in this case, control such a massive percentage of open interest. It's clearly concentration.
I was just going to say, one of the things that might be worth mentioning at this point, because the CFTC meeting on March 25th was actually in relation to potential position limits in the metals markets, and it might be worth maybe mentioning for the attendees here what the current situation is in the fact that position limits only exist on one side of the fence, which is on the longs. There are no position limits for shorts.
Obviously that's something that's being addressed at this point. I think the whole reason that the CFTC had been essentially turning a blind eye to what is really technically an illegal short position, or an illegal concentrated position, albeit on the short side, is because these banks had claimed up until the CFTC meeting that they were in fact hedged in these positions in the over-the-counter markets in the UK on the LBMA. And I think what happened was, cutting to the quick, because obviously we've got a lot to get through here today, but cutting to the quick, what was established at that CFTC meeting is that the definition of physical, quote-unquote physical, is not necessarily physical metal, but actually derivative contracts based upon metal. So completely unregulated, completely unaudited. Gensler and Bart Chilton particularly have a very strong motivation to get transparency into the London Bullion Market Association, into the whole over-the-counter markets, so that there is some form of control. But we won't get into that right now. Obviously, some of this stuff is still the subject of an investigation. But, I mean, really, we're talking about an opportunity here. And we've just talked about, oh, by the way, this last May report, there was just an increase just now of 4,000 more contracts. And we've identified as JP Morgan, is an additional 20 million ounces in 1 month, which is 25% of world mine supply. Now short on the COMEX, and that's not accounting for the much larger over-the-counter markets in the UK, which are much, much larger. So I won't get into the COT reports at this point, but what we've got here is a fantastic opportunity, and I think that's what to look at. There's a physical supply squeeze. Now, since the CFTC meeting, our largest Asian clients, and some of these are banks, are beginning to smell blood. what they're seeing is they're looking and saying, well, hold on a minute. If this is a naked position and it's not backed, then we've got an opportunity. And I think this is so current and yet to play out that I think it's a very exciting time to be in this business. So what Paul also was referring to a minute ago, the US Geological Survey shows silver with 10 years, only 10 years of economic supply currently available. So obviously at these prices, now if the price was $50, obviously that would increase, but essentially it's a very precious metal. The Bank of International Settlements shows notional liabilities, which is listed as, quote, other precious metals, which is 99% silver. They show it in excess of all that future mine supply, so in excess of the 10 years of economic supply. So we've now got a squeeze of major proportions coming here, and the fact that the CFTC, at the CFTC meeting, we identified that this is actually a naked short position hedged by paper on the over-the-counter markets. We've now seen, and essentially this is why the price has risen over $3 in silver and $150 up in gold since that CFTC meeting. We have a short squeeze starting, and we've only just started. Now, you know, obviously silver is a very volatile commodity, and most non-institutional traders will lose all their money trying to trade it. You know, when you've got one player, and we've mentioned that player, when you've got one player controlling the entire market, really your stops are visible, and they know exactly at what level to flush out stops, what to target. They can move silver $1 in a day without any trouble at all, for no particular reason other than and obviously there is a relationship to gold, but that gold-silver ratio can be stretched to enormous degrees too. So basically, up until now, it's been really a one-way street down, with some small rises up, and anyone who's put stops in on a long side has usually got stopped out in quiet Asian markets or at quiet times, or at thin volume times.
Andy?
Yeah?
I just wanted to say one thing, which is this, in case people maybe don't appreciate how potentially volatile silver is. I think it was last Friday at around about 11 o'clock in the morning that the CFTC issued a statement, and it was a fairly innocent-looking statement, which is that they said that they would like to remind all players in the markets that there are position limits, and that they expect them to be adhered to both intraday as well as at the end of the day.